Well, let's bring back in our panel Michael Cox and Ed Al-Hussainy for their takes. Now, Ed, I know we didn't get a chance to get to you before. So in terms of what we were talking about, this expected interest rate hike here, 50 basis points, though, markets off to the races on this news. What were they reacting to that they didn't already have priced in?
Yeah, I think on the margin, we took out some probability of 75 basis point hikes later this year. And so you saw the front end of the Treasury curve really rally as we got those comments from Powell during the press conference. I wouldn't put too much weight on it. I think in the grand scheme of things, what Powell stressed is there's a tremendous amount of uncertainty. There's a tremendous focus now on the data that's going to come in the second half of the year. And the Fed is prepared to do whatever it takes. So is it possible that they'll step up to a 75 basis point pace? Absolutely. I think the question is, by the time we get to, say, a 3% Fed funds rate by the end of the year, where do we go from there?
Hey, Michael, before you were pretty critical of what the Fed has done so far, the fact that it has only raised interest rates by 50 basis points. If you had the ear of the Fed, what should they be doing right now?
Raising rates is not 50 basis points for the next few meetings. And you can't blame this if we have to go through recession, which I believe we will have to. You can't blame that recession on raising rates. You have to blame it on the inflation that preceded it. I mean, to say it's raising rates that causes the recession, that when we had the Volcker tightening of monetary policy, is like saying withdrawing for drugs is what causes the bad feeling. You know, it's the drugs that come first that causes the problem. And that's what we're doing. When you put the economy on an inflation path, the good effects come first and the bad effects come later. The same. And when you put the economy back on a path of inflation withdrawal, the bad effects come first and the good effects come later. Don't forget, we had the strongest economy in many, many years after we extracted inflation out of the economy. During the Volcker years. Very strong economy after that.
And Ed, do you think we'll have to go through a recession? And the Fed chair was asked if the Fed has a credibility problem. Do you think they do?
So far, not really. I think they've buttressed that credibility in the course of the last 6 months by making a very rapid pivot to where we find ourselves today. As Chair Powell said, look, we impact markets and financial conditions through forward guidance. And to the extent that that forward guidance is working, it's a really good signal that our credibility is still with us. And perhaps most importantly, inflation expectations. So far, and again, inflation expectations is a really hazy concept, but to the extent that we can see them in surveys, in market metrics of inflation expectations like tips break-evens, they've not really run away from us. They're elevated, but they've not run away from the Fed. So at this stage, I think the Fed still has credibility. I think it will be put to the test later this year. And whether the Fed continues to tighten policy in response to inflation or whether it steps back is going to have a big role to play in maintaining that credibility into the end of the year.
And Michael, in terms of the added pressure, we did hear Chair Powell talk about the wage price dynamic and saying it's key that price stability exists in order to have a strong labor market versus having people, clamoring for too many jobs that are out there and some of these companies then having to pay them more and that also adding to inflation. What are you watching in terms of that dynamic?
He's right. He's right about that. Well, I'm watching so many things because right now we haven't had an inflation psychology for a long time. And when you start this inflation psychology, people look around and they look at everything they buy is going up in prices. And they think, well, how much do I need to raise my prices? How much do I need to demand more for wages in order to keep up or even get ahead of the prices that I'm seeing? And so for a while, inflation gets ahead of itself. And there's an inflation spiral, a wage price spiral, which exceeds probably what would exist even in the long run. I think that's the period we're in right now. Some of this inflation you're seeing right now isn't permanent. It's once and for all. And those are the kind of things you're seeing coming out of the three things that was mentioned, the oil and gas and the labor shortages and the supply chain shortages. But again, there is a strong underlying permanent element to this inflation coming from monetary policy because of the 43% increase in the money supply since February of 2020.
Ed, from an investment standpoint, how are you navigating some of the uncertainty out there? Because we have high inflation, we have a changing Fed policy, we have geopolitical uncertainty when it comes to what's happening in China, and of course, Russia and Ukraine. What should investors be doing?
Yeah, absolutely. So when you look at the fixed income space, we've obviously had a pretty significant drawdown in valuations in fixed income in the first quarter and well into April. So it's created, I think, a really interesting valuation picture. If you look at the long end of the Treasury curve, 10-year yields about 3%. I think they're starting to look quite attractive at these levels, particularly with the backstop that the Fed is providing in taking inflation and inflation risk off the table as they tighten policy. So to us, the longer end of the curve, I think now is at valuations that are fair to starting to look a little bit cheap. And then most interestingly, I think in the credit space, if you look at the widening in credit spreads, both in high yield and investment grade, look, by and large, they reflect not so much a slowing economy, but rate volatility, underlying interest rate volatility. And so we have high quality, relatively low durations, and relatively interest rate insensitive assets in the front end of the investment grade credit curve, for example, that are offering exceptionally attractive yields. So I think what we're hunting for is long duration in the Treasury space, and then shorter duration, shorter maturity credit products that have cheapened up in the course of the past 4 months.
Michael, it's certainly more important how we get out of this mess than how we got here, but you did assign a fair amount of blame to the Fed. The Fed chair was offered the opportunity to share the blame with the administration and with Congress for flooding this country with money, but he did not do it. He said it is solely our responsibility to get us out of this mess and to control price stability. Does Congress, does the administration deserve a fair amount of the blame for why we got into this mess?
Yeah, I think for two reasons. First of all, they just keep, paying money out. Well, tremendous amounts of money was put into the economy for, payments for workers. People couldn't get to work during COVID, but the Fed could have taken that money back out of the economy. During the Great Recession, the Fed increased the money supply only 12%. And those were hard times, too. That was a longer recession than this one. This recession was only 2 months. It was the shortest recession in history. But during the 16 months of recession, Great Recession, the Fed increased money supply only 12%. But, paradox, you might say, well, why do I blame this administration? Well, this chairman, during this chairman, Powell, we've had the largest increase in inflation that we've had under any chairperson, even going back to G. William Miller now. Now, the opportunity came up to reappoint a different chairperson. Okay? So ultimately, it's the choice of this administration who's running the ship at the Fed. And whether we have a Volcker-type person or whether we have a person who continues to increase the money supply, ultimately it is the choice of the Biden administration how easy they want monetary policy to be. And they're telling you how easy they want it to be right there.
All right, we will have to leave it there. Do thank you both for your insights. Michael Cox there, former Chief Economist for the Federal Reserve Bank of Dallas, and Ed Al-Hussainy, Columbia Threadneedle Investments Senior Interest Rate and Currency Analyst. Thank you both.